On a summer day in 1974, in the aftermath of the most severe oil crisis the world had ever seen, American Secretary of State Henry Kissinger arrived in Jeddah with a proposal that would reshape the global financial system. The agreement reached between the United States and Saudi Arabia was elegant in its simplicity and profound in its implications. Saudi Arabia would price its oil exports exclusively in U.S. dollars and recycle its revenues through American financial institutions. In return, the United States would provide military protection and security guarantees. This arrangement, extended to other OPEC members, created what became known as the petrodollar system. For 50 years, this mechanism anchored the dollar's position as the world's dominant reserve currency. Today, that system faces pressures unimaginable in 1974. This is not speculation about the future. This is documentation of structural shifts already in motion. The origins of the petrodollar system lie in the collapse of Bretton Woods. From 1944 to 1971, the international monetary system operated on a gold exchange standard. The U.S. dollar was convertible to gold at $35 per ounce, and other currencies pegged their values to the dollar. This system provided stability and predictability for international trade and finance, but it also imposed constraints. The United States could not print unlimited dollars without risking gold outflows, as foreign central banks exchanged dollars for gold. By the late 1960s, American spending on the Vietnam War and domestic programs had created persistent trade deficits. Foreign dollar holdings grew faster than American gold reserves. The system became unsustainable. On August 15, 1971, President Richard Nixon announced that the United States would no longer convert dollars to gold. The decision, intended as temporary, became permanent. The Bretton Woods system collapsed. Currencies began floating against each other. Exchange rate volatility increased dramatically. Central banks and finance ministries worldwide faced a new and uncertain monetary landscape. The question became what would replace the gold anchor? What would give the dollar value, if not gold convertibility? The answer emerged from geopolitics and energy markets rather than monetary theory. The 1973 oil crisis provided both the context and the opportunity. In October 1973, Arab members of OPEC imposed an oil embargo against nations supporting Israel in the Yom Kippur War. Oil prices quadrupled within months, from approximately $3 per barrel to nearly $12. Western economies, heavily dependent on Middle Eastern oil, faced severe disruption. Inflation accelerated. Stock markets declined. The embargo demonstrated the power of oil-producing nations to influence global economic conditions. It also revealed their dependence on export revenues and their need for security guarantees against regional threats. American policymakers, particularly Henry Kissinger, recognized an opportunity. If oil, the most critical commodity in the global economy, were priced exclusively in dollars, demand for dollars would remain robust regardless of gold convertibility. Oil-importing nations would need dollar reserves to purchase energy. Oil-exporting nations would accumulate dollar surpluses. If those surpluses were recycled into U.S. Treasury securities and American financial markets, the United States could finance its deficits indefinitely. The system would create a structural demand for dollars independent of American trade balances or fiscal discipline. It was financial architecture of remarkable sophistication. The negotiations with Saudi Arabia succeeded because both parties had clear interests. The Saudis needed security against external threats and internal instability. The kingdom faced hostile neighbors and domestic challenges to royal authority. American military protection offered insurance against both. The Saudis also needed to invest their oil revenues productively. American financial markets provided depth, liquidity, and relative safety unmatched elsewhere. For the United States, the arrangement solved multiple problems simultaneously. It supported the dollar after the end of gold convertibility. It recycled petrodollars into American assets, financing deficits. It created leverage over both oil importers, who needed dollars, and oil exporters who needed American protection. The system's implementation was remarkably swift. By 1975, all OPEC members had agreed to price oil in dollars. The mechanism became self-reinforcing. As more oil traded in dollars, more countries needed dollar reserves. As more countries held dollars, more trade invoiced in dollars became convenient. American financial markets deepened as petrodollars flowed in. Treasury securities became the global benchmark for safe assets. The dollar's share of global foreign exchange reserves, which had declined in the early 1970s, stabilized and then grew. By the 1980s, roughly 2/3 of global reserves were held in dollars, a proportion that would persist for decades. The benefits to the United States were extraordinary. The country could run persistent current account deficits without facing the currency crises that plagued other nations. When the U.S. imported more than it exported, the difference was financed by foreign purchases of dollar assets. This arrangement, sometimes called the exorbitant privilege, allowed Americans to consume beyond their production indefinitely. It also meant that U.S. interest rates remained lower than they otherwise would have been, as foreign demand for treasuries kept borrowing costs down. The federal government could spend without immediate fiscal consequences. The system created what some economists called a deficit without tears. For oil-producing nations, the arrangement was more ambiguous. They gained security and access to American markets and technology. Their revenues, deposited in dollar assets, generally held value and earned returns. But they also became dependent on a system controlled by Washington. Their wealth was denominated in a currency whose value they could not influence. Political tensions with the United States created financial vulnerabilities. The 1979 Iranian Revolution illustrated these risks dramatically. After the Shah fell and revolutionaries took American hostages, the United States froze Iranian assets. Tens of billions of dollars became inaccessible overnight. The incident demonstrated that the petrodollar system gave Washington leverage that extended far beyond military power. The system's stability rested on several pillars. First, American military dominance, particularly in the Middle East, made security guarantees credible. Second, the depth and liquidity of U.S. financial markets made dollar assets attractive. Third, the absence of viable alternatives meant that even countries uncomfortable with dollar dependence had limited options. Fourth, the network effects of dollar dominance created switching costs. Once the world's oil traded in dollars, changing to another currency required coordination among multiple actors with divergent interests. Each pillar reinforced the others, creating what appeared to be a stable equilibrium. Yet from the beginning, vulnerabilities existed. The system required the United States to maintain credibility as both a security guarantor and a financial center. It required OPEC members to continue pricing in dollars and recycling revenues into American assets. It required the absence of attractive alternatives. Any of these conditions could change. Over time, all of them have faced significant stress. The question is not whether the petrodollar system is eternal. The question is what forces are eroding it and how rapidly the erosion is occurring. The first major challenge came from Europe. The creation of the euro in 1999 provided an alternative reserve currency, backed by an economy comparable in size to the United States. Initially, predictions that the euro would rapidly displace the dollar proved premature. European financial markets lacked the depth of American markets. The Eurozone's fragmented fiscal structure created complications, but the euro's existence changed the landscape. Oil producers began invoicing some contracts in euros. Central banks diversified reserves. The dollar's share of global reserves began a gradual decline from peaks near 70% toward 60% and below. The 2003 Iraq War introduced political complications. Saddam Hussein had announced in 2000 that Iraq would begin pricing its oil in euros rather than dollars. Whether this decision influenced American policy remains debated, but the coincidence was noted by other oil producers. The war demonstrated American willingness to use military force in the region, but also revealed the costs and limits of that power. The prolonged occupation, the failure to find weapons of mass destruction, and the regional instability that followed damaged American credibility. For nations calculating whether to rely on American security guarantees, the Iraq experience provided a cautionary example. The 2008 financial crisis dealt a more severe blow. The crisis originated in American financial markets, specifically in subprime mortgages and derivatives. Major American financial institutions failed or required government rescue. The crisis spread globally, demonstrating that dollar dependence created exposure to American financial instability. Central banks and finance ministries worldwide faced a dilemma. The crisis damaged confidence in American financial management, but the flight to safety during the crisis led to increased demand for dollars and treasuries, reinforcing dollar dominance even as its foundations weakened. This paradox, where the system became more entrenched even as faith in it declined, reflected the absence of ready alternatives. China's rise introduced a new dimension. As China became the world's largest importer of oil, its dependence on the dollar system grew. Chinese leaders resented this dependence, viewing it as a source of vulnerability and an extension of American power. China began pursuing multiple strategies to reduce dollar exposure. It established currency swap agreements with trading partners, allowing bilateral trade in local currencies. It launched the Petro-Yuan program, enabling oil purchases in Chinese currency. It developed alternative financial infrastructure, including the cross-border interbank payment system, to reduce reliance on dollar-based payment networks. These efforts proceeded gradually and faced significant obstacles, but their direction was unmistakable. The use of financial sanctions as a foreign policy tool accelerated the search for alternatives. After Russia's annexation of Crimea in 2014, the United States and European allies imposed financial sanctions, restricting Russian access to dollar-based financial systems. The sanctions proved economically painful for Russia, but also demonstrated to other nations that dollar dependence created political vulnerability. Countries with potential conflicts with the United States began considering how to reduce exposure. Russia and China expanded use of their own currencies in bilateral trade. Both countries accumulated gold reserves as a dollar alternative. The weaponization of the dollar system, while effective in the short term, created long-term incentives for de-dollarization. The COVID pandemic and its aftermath brought new pressures. The Federal Reserve's massive expansion of the money supply to combat the pandemic's economic impact raised inflation concerns globally. Countries holding large dollar reserves saw the real value of those holdings eroded. The inflation of 2021 and 2022 was most severe in the United States, meaning that dollar depreciation against other currencies was limited, but the domestic purchasing power of dollars declined significantly. For central banks and sovereign wealth funds, this represented a direct wealth loss. The episode reinforced perceptions that American monetary policy prioritized domestic concerns over the interests of dollar holders worldwide. Recent developments have accelerated diversification trends. In 2023, Saudi Arabia announced it was open to discussing oil sales in currencies other than dollars. This statement, from the nation at the heart of the petrodollar system, marked a symbolic shift. Whether it leads to substantial changes in practice remains uncertain, but the willingness to publicly discuss alternatives indicates changed calculations. Saudi relations with the United States have grown more complex, particularly regarding human rights concerns, Yemen, and the Israel-Palestine conflict. The kingdom has strengthened ties with China, its largest oil customer. These geopolitical shifts create conditions for monetary change. The expansion of BRICS and discussions of a common BRICS currency add another element. While a functioning BRICS currency faces enormous practical obstacles, the discussions themselves reflect dissatisfaction with dollar dominance. Brazil, Russia, India, China, and South Africa represent diverse interests and often competing agendas, making monetary cooperation difficult. But their combined economic weight and their shared interest in reducing dollar dependence create potentials for incremental changes even without a unified currency. Increased use of local currency trade, development of alternative payment systems, and coordination in reserve diversification could gradually erode the petrodollar system without dramatic rupture. The structural shift in energy markets compounds these pressures. The United States has become a major oil producer through shale technology, reducing dependence on Middle Eastern imports. This changes the strategic calculus. American interest in maintaining Middle Eastern stability remains, but has decreased relative to previous decades. Simultaneously, the global energy transition toward renewable sources, while gradual, creates long-term questions about oil's centrality to the global economy. If oil becomes less dominant over coming decades, the petrodollar system's foundation weakens regardless of geopolitical factors. The measurement of these trends requires attention to multiple indicators. The dollar's share of global foreign exchange reserves has declined from approximately 70% in 2000 to roughly 60% in recent years. The share of international transactions settled in dollars has decreased modestly, but remains dominant at around 80% of trade finance. Alternative currency usage in oil markets remains limited, but has grown from essentially zero to several percentage points. These changes are gradual, but their persistence across years suggests structural shifts rather than temporary fluctuations. Financial markets reflect this uncertainty through volatility in currency markets and shifts in asset allocation. Central banks have notably increased gold holdings in recent years, particularly in emerging markets. Gold purchases by central banks reached multi-decade highs in 2022 and 2023. This behavior suggests hedging against dollar-based system instability. Cryptocurrency discussions often reference dissatisfaction with fiat currencies and dollar dominance, though whether digital currencies represent a viable alternative to the dollar remains highly debatable, given volatility and regulatory uncertainties. The implications of petrodollar system erosion extend beyond currency markets. If the dollar loses its unique position, American borrowing costs would likely increase as foreign demand for treasuries decreases. The federal government would face more immediate fiscal constraints. Interest payments on the national debt would consume a larger share of the budget. The adjustment process could be gradual or abrupt, depending on how rapidly confidence shifts. Historical examples of reserve currency transitions suggest the process typically unfolds over decades rather than years. But historical examples are limited and may not predict future patterns. For the global economy, the transition creates both risks and opportunities. A multipolar currency system might be more stable, reducing dependence on any single nation's policies. It might also be more chaotic, increasing transaction costs and exchange rate volatility. The transition period itself likely involves instability, as old arrangements break down before new ones fully form. Managing this transition without triggering financial crises requires coordination and careful policy management across multiple nations with divergent interests. The historical record of reserve currency transitions offers limited guidance. The British pound sterling dominated global finance in the 19th and early 20th centuries before gradually ceding dominance to the dollar across the mid-20th century. That transition occurred across decades, accelerated by 2 world wars and British economic decline. The process involved financial crises, competitive devaluations, and significant economic disruption. Whether a future transition would follow similar patterns depends on factors difficult to predict, including technological change, geopolitical stability, and policy choices. The role of American policy choices cannot be understated. Decisions about fiscal discipline, monetary policy, financial regulation, and foreign policy all affect dollar attractiveness and the petrodollar system's stability. Aggressive use of sanctions increases incentives for alternatives. Large fiscal deficits and money printing raise inflation concerns. Financial instability damages confidence in American markets. Conversely, maintaining institutional quality, deep liquid markets, and credible governance supports continued dollar dominance. The United States retains significant agency in determining how rapidly the system evolves. As we document these patterns, we observe a system under stress, but not yet in crisis. The petrodollar arrangement that emerged in 1974 reflected specific historical circumstances that no longer fully obtain. American military dominance persists, but has been questioned. Dollar alternatives exist in ways they did not 50 years ago. The geopolitical consensus that supported the system has fragmented, yet the system's network effects and the absence of a clear successor create inertia. Change occurs incrementally through thousands of individual decisions by central banks, corporations, and governments, rather than through dramatic announcements or events. The question is not whether the petrodollar system is permanent. Nothing in monetary history is permanent. Currency arrangements evolve as economic and political conditions change. The question is whether we are observing the beginning of a fundamental transition or merely cyclical fluctuations within a durable system. The evidence suggests something more than cyclical fluctuation, but less than imminent collapse. We are documenting the early phases of what may be a multi-decade transformation in global monetary architecture. The archive remains open. The pattern is emerging. The conclusion remains unwritten.